Welcome to the coffee shop. This is your host and barista, and in today's video we are going to be finding liquidity. This is just a 10-minute segment of a lesson plan that I did with a group called Trade with Confidence. In today's episode of Finding Liquidity, I'm going to show you how to validate that and find it in the market in any time frame. So this is lesson plan number 1. It's only 10 minutes long. Watch out for lesson plan number 2. Okay, good. So sorry I didn't start the recorder until now, but yeah. And of course, if there's anything that you guys want me to cover, like, you know, anything that you may have like slept a little bit on, not quite grasped, or whatever the case may be, feel free to ask. You know, that's why I'm in this group anyway. There's a lot that you guys already know, but there's a lot when you guys get to your excelled level. I'm talking to the majority of the people that are in the room. When you get to your excelled level, it's very easy to forget some of the basics and just kind of not see it. Okay, I know a lot of you are on, like, you know, minute, 2 minute, 3 minute, 5 minute scalping time frames, and things happen very quickly. So it's easy to get lost. Like, it's easy to get lost. Like, you're seeing this, okay? You're seeing this, but you have no idea what's happening overall in the market. You don't realize you just had this massive uptrend and you should be losing momentum here. It's easy to get lost and say, oh, I should be scalping. Big, you know, buying pressure. I come down, you know, buying pressure again. I come down, I'm expecting buying pressure, but no, it goes against you. And you just, this is where you start losing out. Just based on the previous price action, I can already tell that you have a divergence forming here. I'm seeing that without seeing the oscillators or RSI or anything like that. There's a divergence here without question. Okay. And if I open one up, we'll see it, but you know, we're getting away. I want to get away from the topic at hand. So right now we're talking about, okay, here's a recap of what we were just covering, right? Any messages you need to look at? Okay. Nope, not yet. Any questions? Feel free to put it in the chat room, guys. So the only thing I'm talking about right now is how you get breaks of structure. Okay. And a break of structure, let's say you're in a long, like, and I'm just talking about the short term, okay? Not going to look at the long term. Your short term is long. Your structure is broken to the long side. Anytime you get a close above the high, that resulted in it has to happen, that resulted in a higher low. It is not when you get an equal low, okay? That's a whole different thing. And I don't want to talk about that because that's even further in depth, talking about, you know, market flips and, you know, double change of character, multi-time frame stuff. That's what that is. If you get a double bottom that breaks a previous high, that is not a true break of structure. Okay, you have to look for a new structure. Okay, that's what ends up happening there. As an example, here's one here. Okay, you get a double bottom here. Okay, your structure, you would allegedly say, here's my break of structure. That is not true. That is absolutely not true. Your structure is actually here, okay, and you broke it here somewhere. You broke it crossing above, but you needed new highs. You know, like, you needed new highs. Your high was here, you broke it. None of this matters. None of this is it. It's not important. Okay, and in another segment I'll explain to you why none of this matters. Okay, just for right now it's irrelevant, but that's, I wanted to show you that little quick drawing to get you to understand why it's complicated. So anyway, if you get a low, high, or low that breaks a previous high, then you have broken structure. The reason for that is because you were able to push up, something happened, you were able to push down, right? So this is the actual structure that's trying to form against you, and you are moving up and you are breaking against the structure that's forming against you. That's what you need to do. You cannot have structure forming against you, right, that is longer than the structure you are forming. Okay, and what I think, when I kind of word it that way, it's a lot easier to understand. You know, you are forming long structure. You cannot form longer short structure. You cannot do that. That's what happens here. See, longer short structure. Let's put this back up here. Now, this is not seen, just a recap that I'm doing right now, this is not seen as proper support until you get a close above this level and you stop at some point creating, you have to create a higher high, right? You can close up here to break the structure. You didn't create a higher high until you pull down and make a low, moves up a little bit, that is higher than the previous one. Okay, So you break structure, you have to wait for all of this to happen before you understand you have a new high. You can't have a high without having two lows. It just doesn't exist. Like the math for that doesn't exist. I don't know what world you may think you live on, right? That's a high, okay, with two higher lows. If you didn't have this and you simply closed above some candle and then the trading session stopped, you don't have a higher high because you have no low anywhere to compare it to. So you have to have that, okay? So, and this is for some of the new people that are listening, whether you're in the room or not, whatever. This is going to be for the recording. Next topic that we're going to be covering here real quick. Let me see. Let me just pop this open. This is why I made a list. Liquidity, flat zones. Oh, no, so that's the secrets of the algo. Okay, higher highs. So if you want to look at lower lows, I can do the same thing, but I don't want to make this take too long. Lower lows is just the same thing, just upside down, right? You're just looking for breaks of structure to the low side, and you have to make a move back up that does not exceed the previous move, you know? So if you got low and, pulls up a little bit, and you get a lower one, and it pulls up a little bit, okay? This is a low and a lower low with a lower high. You have to have that shape. It's got to be like weird, upside down check mark. It's got to be like that, okay? It cannot be like this. I mean, it could be really steep. It's fine. It can't be like this, right? You can't have that. Even if you have an order block inside here, which is something I'm going to cover in just a few minutes. Even if you have an order block inside here, all you did was break an internal order block. Okay, that's it. You made a breaker block. So we'll get to that in just a second. Okay, so what do you call it? Lower lows, just the opposite of higher highs. That's all that really is. And anybody in the room, do me a favor. I know some of you grasp it very easily. If you do not understand finding liquidity that was left from swing points, if you don't understand that, let me know right now. I'll be more than happy to backtrack on that. I know I went through it very quickly. Liquidity is an awesome thing to find, and and what do you call it? A lot of people will say, when do I target liquidity? You target liquidity as your target. That's it. Okay, so yeah, on drawing liquidity, no problem. Let me wipe out everything on the chart and I'll show you exactly only liquidity, okay? Because I may have had too much stuff on the chart. But one thing I want to answer ahead of time before I forget is, what do you do with liquidity? Well, actually, you just leave it there on the chart. That's it. All you're doing is you're drawing a place on the chart where orders were, how do I put it? Unused. And I think when I draw it, you'll see. Basically, let's say you have, it's, what do you call it? It's bullish liquidity, okay? Bullish liquidity means price came down, made a low, price then moved up, and it did not break the previous high. That means you can consider, you can say that the bulls did not use enough of their orders to break structure. They used less of their orders, like they used less buying orders, and the market did not move far enough. So that means the bulls still have more orders used because they're always trying to break the previous trend, right? Let's wipe this out. Working off of this zone again, right? Yeah, let's just work off of this zone. It's a nice zone to use, okay? I'm just seeing if there's another one real quick, sorry. Okay. So what I said before is that you've got liquidity, essentially. Wait, where's that liquidity zone? Right, got there. This breaks this one. Okay, so yeah, liquidity is right there. So first I'm going to draw it, and then I'm going to show you how you draw it, right? So you've got this push down. Then you got the swing down here, right? I'm looking for the swing. I'm looking for any low that was created below it. I see this candle's got a little gap in it. I'm going to use that one, okay? And I'm glad that's there because that's important. We often wonder, what do we do with gaps? For me, through my study, if you have a gap between two candles and there's only a wick, right? If there's a wick preceding that, what is the wick? What did I say earlier, right? This is where majority of the selling pressure is, okay? So you got selling pressure here. I want to use this. I'm going to go from here to this candle right? You usually want to go to the close.
All right, everybody, thank you for watching that
close
10 minutes of that
below this
1.5
value.
hour
Just look to the
segment.
left.
The next episode is the following 10 minutes, and I've broken this 1.5 hour session up into just 10-minute segments, so you can watch them individually as you choose without having to watch the entire thing through. So make sure to get the next video. It will be uploaded very soon. Just make sure to look for it in the playlist. Peace.